Phoenix Group is the UK's largest long-term savings and retirement business. We have assets under administration totaling something like 0.3 trillion pounds. We've got around 12 million customers. And although lots of people haven't heard of Phoenix Group, they will have heard of our various brands, and most notably Standard Life. So I think the first thing to say is that managing risk and realizing opportunities for our customers is at the absolute heart of our transition plan. It was very much a customer first transition plan, and everything we do has to be in their interests. Before we embarked on developing the transition plan, we already had a relatively mature process in place for assessing climate risks and opportunities through the TCFD process. And so everything that we did there formed the basis of our thinking on risks and opportunities that then fed into the transition plan. It's a whole combination of approaches that utilize both quantitative and qualitative analysis, and it includes things like annual stress and scenario testing, ongoing scanning of emerging risks and regulatory changes and market changes, ongoing carbon footprinting exercises where we're both broadening the overall scope of the portfolio that we footprint, and in our transition plan, in fact, we include a roadmap for how we have broadened and how we will continue to broaden the coverage of that, and then refreshing our carbon footprints. And then monitoring our progress against climate risk metrics and versus our risk appetite and various external targets. So there's a whole load of things that go into that process, and it's a company-wide effort. So key teams that contribute to that include the risk team, the sustainable investments team, and the broader asset management world. Us within the central sustainability team, our customer team, and so on. So it's a really company-wide process. So our net zero transition plan covers the entirety of Phoenix Group as an organisation. So that's our investment portfolio, our operations, and our supply chain. And within the investment portfolio, the entirety of the investment portfolio. And perhaps unsurprisingly, it's the investment portfolio that's the key area where we identified risk and opportunity. And unsurprising, because apart from anything else, they account for that portfolio accounts for around 99% of our overall emissions and carbon footprint. Within the investment portfolio, what we found was that our emissions are really concentrated around quite a small part of the portfolio. So, for example, in 2021, our financial exposure to high transition risk sectors such as energy, utilities, and industry and materials was 20%. So 20% financial exposure, but that accounted for over 70% of our emissions in our listed equity and credit portfolio. So, not quite the 80-20 rule, but not far off, a real concentration of emissions, and therefore risk and potential opportunity in that smaller number of sectors and smaller number of investee companies. I think probably the key challenge for us and for probably most other people is around getting good quality data on our investment portfolio to really understand the potential impacts of climate change. And given the makeup of our business with so many different asset classes and 0.3 trillion of assets under administration, that's no mean feat. And with all of this kind of analysis, the insights that you can draw, the conclusions you can draw are only as good as the data that goes in. One of the other key challenges that we faced, and I know again is common to many, was navigating the limitations of the climate scenarios available across the industry. And there's a sort of a nagging concern that many of those scenarios that we used don't necessarily reflect the full extent of the possible climate risk impacts that we're facing, and that's especially especially the case when it relates to physical risk. So earlier this summer, the Exeter University, the Emperor's New Climate Scenarios paper came out and made a bit of a splash, and that was certainly a conversation that we've been having internally for quite some time. Yeah, so dealing with uncertainty is inherently a part of planning and then delivering the transition to net zero, especially if, like Phoenix Group, you're so dependent on what happens outside your control. In our case, the rate, for example, the rate at which the real economy decarbonises. So the first thing that's super important is that we have been always totally transparent with all of our stakeholders about the extent of that uncertainty. And then in terms of how we try and operate within that context, the first thing is the approach we take to assessing risks and opportunities and then determining the best course of action is based on triangulation. We don't just rely on one data source or one approach. We take many approaches and then triangulate from the different, those different approaches. But one example of how our assessment of risk and the realization of the extent of its concentration, how that fed through to then the actions that we set out in the transition plan, is around our stewardship strategy. Another thing that our assessment of risks and opportunities highlighted really clearly was the extent to which we are dependent on action from others to get to net zero. We can do all of the right things, everything within our control, and push really hard on that front. But if we want to deliver net zero in a way that delivers a real economy decarbonisation, we can't do that without lots of other people taking action, whether that's governments setting supportive policy, high emitting companies taking action to decarbonise, or robust offsetting markets developing. That all has to happen from others. What we were really clear about in our transition plan was that, having kind of come to that maybe you might say fairly obvious realization, we weren't going to be passive about it, and we've set our stall out to very actively lean into that situation. So a key pillar in our transition plan is engagement, and a key part of that is engaging with the wider ecosystem that we sit within to drive that wider system change that needs to take place in order for us to be able to deliver net zero within our organisation. A good example of how that played out, how our risk assessment fed directly into the actions set out in the transition plan, is the customised decarbonising benchmarks that we're planning to apply ultimately across our listed equity and credit portfolio, starting with 40 billion of US and UK listed equity. And we talk about this in our transition plan. So these benchmarks have been designed essentially to reduce our customers' exposure to companies who don't necessarily have a credible transition plan or journey to net zero, and to increase their exposure towards those that do have those credible transition plans. So this isn't about tilting lock, stock and barrel away from certain sectors. We remain exposed to the wider economy broadly as we were previously, but it's about tilting within those sectors to the companies where our analysis indicates that we'd be exposed and our customers would be exposed to lower risk. So having published the transition plan, our inaugural transition plan in May, the expectation is that we won't publish another full transition plan for 3 years in line with TPT guidance, unless something fundamental changes. So this time round was obviously the first time we've been through the process, and to some extent it was a voyage of discovery. Next time round will clearly, all else being equal, be a more efficient process, simply by dint of the fact that we've been through it once already. I think the other thing that will have changed, which will make a material difference to when we publish our next plan in 3 years' time, or 2.5 years' time now, is that the industry guidance will be that much more mature. Because when we were developing our transition plan, we were also working with the TPT in parallel on refining the first round of industry guidance, and so it was very much a sort of an evolving space. And even since we published the plan in May, we've been involved in lots of conversations with the TPT, with GFANZ and with others, which have been super helpful. And now that a few organisations have been through that process once, it's been invaluable in really refining that guidance to a set of guidance that really works, and in particular that works for our context as an asset owner.